Hey everyone. Tesla reported its latest quarterly earnings results and the stock price is up 10% as of this recording in the aftermarket hours following the earnings release. So I'll review what Tesla just reported, what it could mean for Tesla stock investors. I'll update my recommendation of Tesla stock. Remember, coming into the quarterly earnings release, I did not have Tesla stock rated as a buy. So if you listen to that recommendation, you would have missed out on these 10% gains in the early aftermarket hours trading. So far, recommendation was not the right one to make. However, tomorrow and the days following could be a lot different. This is just the initial market reaction to Tesla's earnings. And I'm going to share with you, it was a mixed bag. There was some good and some bad. So let's review these numbers.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Tesla starting off with the sentence, we experienced numerous challenges in the first quarter. That was an understatement. The first quarter was arguably the worst first quarter in Tesla's history, going back at least 5 years. Revenue declined, total automotive sales decreased, production and delivery decreased, inventory increased as demand struggled. And they discussed that, right? Global EV sales continue to be under pressure as many car makers prioritize hybrids over electric vehicles. Now, many car makers are prioritizing hybrids because that's what customers want. Customers are over and over again through their purchasing decisions reminding car companies that EVs are not what they want. On the flip side, governments worldwide are trying to force EVs down people's throats. That's an interesting scenario, right? That governments are trying to force people to buy electric vehicles when people much rather prefer other types of vehicles, hybrids or internal combustion engines. So it's an interesting scenario here. And it remains to be seen how much money the governments worldwide are willing to spend to force people to buy the less desirable product. Interesting. And I will be following that going forward, given that even though they're spending this much money, EV sales are declining, as we'll see with Tesla. So the company saying, to support our growth, we have been increasing awareness and expanding vehicle financing programs, including attractive leasing terms for customers. And that's just a few of the things they've been doing, along with price cutting, along with other incentives and promotions to try and get people to buy the car, because organic demand has been falling. Even after all of this support that Tesla introduced into the market, total automotive revenue declined by 13%. This led Tesla to shift direction. So some of the decisions they're making included $2.8 billion in capital expenditure, ultimately focusing on more profitable growth, including leveraging existing factories and production lines to introduce new and more affordable products. This is, in my opinion, why the stock price was up by double digits in the aftermarket hours, is the fact that Tesla, first of all, reducing the likelihood of an expensive new manufacturing facility. Remember, they had been flirting with the idea of opening a manufacturing facility in Mexico. Now, in this quarterly update, that seems like it's pushed further out into the future and may not happen at all unless customer demand really increases, which it doesn't look like to be the case for now. And that's good news for investors, because investors are saying, okay, that's less money that Tesla's going to spend on expansion when customer demand is not there. That's a good decision. They like that. And that sent the stock price up. Remember a couple of weeks ago, or I should say more than a couple of weeks ago, but when Rivian made a similar announcement saying that they're going to pause production of their manufacturing expansion, as these EV automakers or EV makers realize and adjust their expectations to right size along with where customer demand is, investors are going to cheer that news. They're going to like the fact that these EV companies are not looking to expand their manufacturing facilities at a time when it's becoming clear that customer demand for these vehicles is not that strong. In fact, customer demand is significantly less than the existing manufacturing capacity that exists. So there's already an oversupply of electric vehicles in the market. And so if you're a company and you're introducing an expansion into a scenario that's already got oversupply, that's really difficult to convince investors that's going to be successful. So investors are cheering this decision to pause or push out that expansion opportunity for Tesla. Also, this kind of brings back into focus the lower priced model. Tesla's kind of hinting at the lower priced model coming out, and being able to produce it in its existing facilities, not needing to open a new facility to make that lower priced model. So that was good news as well. Although I will discount always whatever Tesla forecasts, because so often Tesla has forecasted something and it hasn't came to fruition, or it forecasted something happening in 2019 and here we are in 2024 and it still hasn't happened. So whenever Tesla gives a forecast or gives an expectation of something that's going to happen in the future, I always reduce the probability of that appropriately, given Tesla's lack of hitting these targets or low percentage of hitting these targets. So it's not a 0% chance. I'm not saying it's 0%, but I'm lowering the probability. And then finally, they lowered the price of the full self-driving supervised. Of course, it's not full self-driving. It's nowhere near that. The weather has to be perfect. Everything has to be right in order for Tesla to be able to deliver that full self-driving experience to people. And it's expensive. It's still $100 a month or $8,000 for essentially what's like cruise control. I'm not going to pay $8,000 for something that I have to be driving anyways. I have to be sitting in the driver's seat and I have to be ready to, so I can't do anything else. I have to still be driving. So why would I pay $8,000 for this feature? I'm not the market for it. Maybe some other folks would be interested in this. And it's clear many folks are interested in this. They are making sales of this product and people are using it, although it seems impractical for now at the very least. All right, now for the really good stuff. Total revenues down 13%, automotive revenues. Remember, before the earnings release, Tesla already gave investors an update on the production and delivery numbers, and those were down year over year. Investors were already expecting this number to be lower. 13% lower is much more than investors were expecting. We were expecting something in the mid-single digits, given that was roughly where the decrease in production and delivery was. So total revenue was down 9%. Its energy and services segment did well, growing 7% and 25%. There's still a relatively small part of the business, less than $4 billion in revenue combined from those two segments, for a business that had over $21 billion in revenue. Gross profit margin was a bright spot. I was expecting a much more significant drop in gross profit margin. It only fell from 17.6% to 17.4% quarter over quarter. And year over year, it only fell by 1.9% from 19.3% to 17.4%. I was expecting a bigger drop given the decrease in production and delivery and the decrease in average selling price. I thought that was a bad combination, but only 1.9% decrease. More is likely to follow over the next few quarters. The operating profit margin is where it saw the biggest decrease, falling from 8.2% all the way down to 5.5%. Operating income in total falling by more than 55%, down to $1.17 billion from $2.66 billion. To make matters worse, free cash flow turned significantly negative, wiping out years of progress. Free cash flow now negative $2.53 billion. Cash flow from operations only $242 million, down 90%, as the company had to invest billions of dollars into its facilities to upgrade and implement these new plans, to launch the Cybertruck, to introduce that newer updated Model 3, all of which weighing on its free cash flow, and then the inventory buildup hurting its cash flow from operations. So the current quarter, the actual results from the current quarter, I would say were worse than expected, were outright bad. You're seeing declines in revenue, in profit margin, in cash flow, in free cash flow across the board. Worse, not very good. The good news came from the outlook about reducing expansionary ideas and potentially making the lower priced model in existing facilities. That was the good news to offset all of the bad news. But again, given Tesla's poor history in forecasting and hitting targets, I'm reducing the probability of them hitting those targets. I mentioned the stock price was up 10% when I started the video. Let's see how much it's up. It's still up 10% as of this recording. And coming into the quarter, I highlighted on April 19th that I did not have Tesla stock rated as a buy, and I was advising investors not to buy before the earnings release. So if you took that advice, you would have missed out on this 10% gain. Now, to update my recommendation, is it a buy after these earnings results? No, I don't think so. I didn't see anything in these earnings results that would make me more interested in buying Tesla stock. I'm happy that they're not investing in expansion in an industry that's already in oversupply. So that was good. Other than that, I didn't see anything in there that was enticing to me to want to jump into this stock in an industry that's in extreme peril. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.